Hi, everyone. We are Group J, and today we're going to be talking to you about Chapter 17 of Financial Life Events and Fitting the Pieces Together. My name is Devin Reyes, and alongside me is my team, which includes Hannah Paul, Luis Shaw, and Andre Madrid. So I'm going to go ahead and start off by talking about the ingredients of success. Now, there's no clear definition as to how to achieve financial success, but together with the following summarized bullet points, by putting these into action, ultimately it'll help uh, achieve your financial success, especially from now at a young age. So the most important ones that we think that stand out amongst these is number one, planning and budgeting. Of course, it's important to be a proactive individual and a proactive saver and investor. So what's important as part of your financial success and your financial blueprint is that you're a proactive individual and you're not reactive to your financial situations. Number two is managing your cash and credit card, being able to balance what your debts are and taking into consideration the importance of your credit scores and making sure that your cash is always allocated successfully so that this way you can save for your future while also accommodating for your spending habits today. Um, Another important ingredient of success is understanding the investment tenets. And what this means are the principles, having a game plan in place, having outlined goals, and making sure that you're revisiting these goals and outlines periodically so you can stay up to date. And then lastly, of course, planning for retirement. Like I said, it's always good to plan early, always good to get ahead. So make sure you're doing that. So the financial life cycle. So, you want to consider first, where are you now? Pretty much everybody in this room lands in the early years or wealth accumulation stages. And this is ages before 54 years old, where pretty much you're earning most of your income. You have a few of your biggest purchases, such as your home purchase. You're starting the process of raising a child. You're graduating college. You're starting your career, and you've created savings goals for the future. Now, this does vary person to person. No two people are the same. But overall, most people under the age of 54 do fall into this category. Stage two is the golden years when you're nearing retirement. So this is where you want to take the time to take a step back and reassess what your retirement goals are. And your financial goals will likely shift as you begin your estate planning. And then stage number three, of course, is your retirement years. Excuse me. Number three is your retirement years, and this is in the late 60s. And at this point, you're no longer saving; you're actually spending. So this is important that you have a game plan in place so that your savings can continue to grow while your spending habits um, take over. Now, the basic principles of personal finance are the same for men and women, as is the desire for financial security. However, the effort needed to achieve their financial goals does differ ultimately, because it's much tougher to achieve your financial goals and your financial security if you are a woman. Some of these reasons are because women generally earn less money and they're less likely to have pensions. And often because of this, there's less income from Social Security because they may earn less on average over time. So as you could see in the graphic alongside me, women live on average 7 years longer than men, which of course is a benefit. But in the eyes of financial planning, it can be seen as a disadvantage when it comes to planning for retirement. So ultimately, it's important to plan early. Now, there is a beginning for everything, and especially with your financial future. Most of us tend to think about this as when you're getting started, graduating from college, or with the realization that we have to get our financial future on track. So we must take the steps, the time to look at the steps involved in getting started. So life event number one entails getting ready for your professional career and um, ultimately your career goals. So this includes investing in yourself and being able to describe what you do. So start by laying out a groundwork and a foundation. Um, by tracking your expenses and creating a budget and controlling the amount of debt that you take on in these early uh, stages of this life event, you can make sure that you have a good credit score, a strong savings plan. But this way you can make adjustments as necessary. Examples of a savings plan or a savings account can be an IRA or 401k, as we've discussed in previous chapters. So a good example of life event number one is pretty much where we're about to be. We're about to graduate college and figure out what our career outside of school is going to look like. So start making a plan. Now, life event number two is marriage. And this is, I'm not referring to the actual wedding or the honeymoon, but rather what your financial life will look like together with your spouse. So divorce, of course, is a financial disaster and nobody wants this. And ultimately, it can lead to financial hardships. So the most important part of life event number 2 is having the hard conversation. Take the time to gather all your financial information with your spouse and sit down and collectively come up with an action plan as to how you're going to budget your lives together. Oftentimes, this conversation can be a little bit difficult, but it's important that it's held early so that the financial success throughout your marriage can continue. When you're talking with your future partner, you want to ask the important questions. How are they grown up? What were their spending habits? Do they want to work once they've had a child? Or once you're married, what are your investment strategies going to look like? And do you want to share accounts or do you want to have individual investment strategies? Ultimately, you want to get organized with your finances and revisit your financial goals to make sure that you align with your spouse and examine your insurance and benefits. You can examine your taxes, make a will, but of course, make it work. Now, life event number three, may just be your biggest investment throughout your whole lifetime. So the first thing you want to do is make sure that your purchase fits your financial plan. Make sure that your purchase falls within your limits of your financial goals, by thus keeping track of your credit score, your debt levels, and any payments that you may have to make in the future to own the property. As part of as part of your home purchase, you may want to just take a look at the tax benefits along with buying the property, because these advantages can ultimately help build into your budget. So you want to include all your tax savings, which can include home mortgage interest and real estate tax payments into your budget. Also take care of the details. Make sure all your credit card companies, banks, financial institutions have all your updated information for your new home so they know where to contact you. Life event number 4 is having a child. Now, certainly there's more to life than money, as raising a child is one of the most beautiful experiences, but you want to make sure that you can enjoy these years with your child. So number 1, you want to assess your current financial situation and reconsider your financial goals with a new child in mind. Your financial goals can be short and long term, but they may change accordingly. So revise your budget and make a plan for retirement. Many families choose to save for their children's college education early. So examples of these can be a 529 plan, or for those of you who are from Florida, of course, I've heard of a Florida prepaid. But another step is to consider that updating a will and updating your trust is crucial. You want to designate a guardian for your child and specify your funds, so you can distribute them in case anything happens to you or your spouse. So update your beneficiary designations. And then life event number 5 includes inheritances, bonuses, and extra or unexpected money. Unexpected money can go a long way in helping you reach your goals faster than you even anticipated. In the case that you do receive unexpected money, take the time to re-examine the priority of your goals and identify the goals that are most important to you. Then you can use this unexpected money to go towards reaching that financial goal and accelerating the process ultimately. Also, be sure to examine the tax implications before you make any ultimate decisions. Now, Hannah's going to go ahead and continue the conversation and discussing life event number 6.
Hi everyone, my name is Hannah Paul and I will be continuing on with major life events. Life event number 6 is a major illness. It can happen to anyone. In fact, most of us know someone who has had to face the news of a major illness. Step number 1 would be to re-examine your finances. Assess where you are now and make sure you have adequate liquidity for any emergencies. And 2 aspects we would like to highlight is re-examining your investment strategy and revising your budget. In re-examining your investment strategy, you want to think about your time horizon. Your working time horizon may be shortened. For example, you may now expect to work 5 years instead of 15. Since you may be tapping into your retirement savings earlier than expected, you may need to change your asset allocation to reflect your shorter investment time horizon. In revising your budget needs to reflect the new expenses you're experiencing and your redefined financial goals. Step number 2 would be to take advantage of tax breaks. With an increase in medical expenses, there may be an accompanying increase in tax deductions. Make sure you take advantage of any tax breaks that may come your way. Step number 3 would be to find alternatives to finance your illness. Some alternatives include getting a reverse mortgage. You must be at least 62 years of age. With a reverse mortgage, you maintain ownership of your home just as you would with a normal mortgage. You pay your real estate taxes and homeowner's insurance and maintain your home just as before. Of course, you've got to remember that with a reverse mortgage, you won't be leaving the house to your kids. Instead, it will be left with the bank. Another thing to look at would be disability insurance. Depending on your insurance coverage, short or long-term disability benefits may be available should you be unable to return to work. Life Event 7, Caring for an Elderly Parent. Step number 1 would be to look at healthcare and estate planning concerns. Initiate a dialogue with your parents and make sure their personal needs and wishes are being expressed. Step number 2 is to oversee your parents' financial affairs. Some things we would like to highlight are gaining an understanding of their goals and budget, discuss their financial goals, and make sure they are receiving all the benefits in terms of pensions and social securities to which they are entitled. You'll also have to look at durable power of attorney. Try to have your parents look ahead to a time when they might not be able to make their own decisions or manage their own financial affairs. Step number 3 is to discuss long-term healthcare options. Make sure your parents are aware of the options and costs of long-term healthcare. Step number 4 would be to take a look at estate planning. Depending on the size of your parents' estate, you may want to preserve their estate through estate planning. If the estate is large enough, gifts of money and other assets may be recommended. Life Event 8, Retiring. Retirement means that you'll be living off any income you continue to receive, your personal savings, your pension if you have one, or any other employer-provided retirement plans, and Social Security if available. Step number 1 is to develop a retirement income plan. Something we'd like to highlight here is you should plan how you will use your retirement savings. A well thought out plan will help you make decisions as to when to tap into different retirement plans. For example, any 401ks, 403bs, and 457bs that you might have, as well as your Roth or traditional IRA. Rules regarding distribution and taxation vary for different accounts, so use the rules to your advantage or seek professional help. Step number 2 is to manage your income in retirement. Make sure you have a withdrawal strategy. Establish an appropriate withdrawal strategy to help ensure that your assets last your lifetime and keep taxes to a minimum. Step number 3 is to review your insurance coverage and your will. The loss or reduction of your retirement income could adversely affect your surviving spouse or family members. Life insurance can provide financial resources they will need during a difficult time. Step number 4 is to keep track of important retirement planning dates. Financial milestones abound as you approach retirement, so keep a close watch on these important dates in your life. Life Event number 9, Death of a Spouse. Step number 1 is to organize financial material. Collect the papers necessary to file for benefits and finalize the estate. If there is a will, locate it. This will represent the first step in distributing the assets. Step number 2 would be to contact sources of survivor benefits. Make sure you receive any benefits to which you are entitled. Step number 3, if you are the executor, carry out your responsibilities. If you are an executor, you're responsible for overseeing the estate and managing it through probate, making sure expenses and taxes are paid, and satisfying any financial obligations that may exist. Step number 4, change ownership or title to assets. Make sure that ownership or title assets is changed, and this includes insurance policies, automobiles, bank accounts, and credit cards. Step 5, review your financial and retirement needs. With the loss of a spouse, your financial needs will change. You'll want to do the following. Determine if your benefits change. If your spouse is covered by a pension, your future benefits may change as a result of his or her death. You'll also want to review your insurance. You may no longer need to have the same level of insurance that you do if you do not have dependents. This table represents a few financial milestones, what to do, and the correct time to act on them. This includes applying for Social Security benefits, when you can receive distributions from your retirement accounts, and when you can become eligible for a reverse mortgage. Life Event number 10, Divorce. Not only are money problems the major cause of divorce, but also divorce usually leads to reduced income and the burden of expenses that were formerly shared. Step number 1, prepare for divorce. Pay down your debts. Dividing assets is tough enough. Try not to have too much debt to divide as well. Another key aspect is keeping the cost down. The nastier the divorce, the more the cost. Keep things as civil as possible. Step number 2 is to avoid credit damage. One thing to take a look at is joint accounts. Having the divorce finalized isn't enough to separate accounts that remain open in both names. You'll have to take care of that. You may not feel financially responsible for these accounts, but monitoring them to make sure payments are made will be in your best interest. Step number 3 is to revisit your financial goals. You'll also want to take a look at Social Security and your ex spouse's earnings history. If your marriage lasted 10 years and you didn't remarry, you may be entitled to Social Security benefits based on your ex spouse's earnings, even including earnings after the divorce. Step 4 is to re examine your insurance coverage. If you have been covered under your ex spouse's policy, make sure coverage continues for you and your children. Step number 5 is to rework your budget. Your budget should reflect your new income level and burden of expenses that were formerly shared. You'll also want to take a look at your emergency fund. When you're on your own, you no longer have a partner to rely on if you run into financial trouble, which makes having an emergency fund even more important. And lastly, take a look at tax breaks. Your loss of income may qualify you for tax breaks to which you weren't previously entitled. Your filing status and standard deduction will change, as may your right to claim your child as an exemption, depending on the divorce decree. So plan accordingly.
Hello, my name is Andre Madrid, and I'm here to present the keys to success. It goes without saying that we will all face financial hurdles that in the process to building our wealth, some of which we won't be able to anticipate. However, we may be able to prevent the severity of the situations with a profound and robust understanding of wealth planning. The first key to achieving this is to become knowledgeable. A fundamental understanding of personal finance can prevent several financial pitfalls and bad advice. It could also help in our selection process of advisors and can prevent us from falling prey to advisors that are only going to lose us money. It will also enable us to appreciate the fundamental financial concepts that affect our investments and allow us to invest and take action in investments that are going to yield us more in the end. This can hopefully prevent large financial losses that may result from unexpected life accidents. The second key is to not procrastinate. Time is of the essence. While bad advice might slow you down, procrastination does not even let you get started. Timing can be everything, especially when you're dealing with situations such as savings. While people say, oh, I'll save in the future, I'll be making more money in the future, I'll have more to save, this isn't necessarily true. While you may be earning more, your expenses will also likely increase. And it won't allow you to take advantage of some financial concepts such as compound interest, which we'll get into right now. With compound interest, the most important factor is timing. Essentially what it is that you'll save in the beginning, and the sooner you start, the more and more you'll be able to earn on interest, and then the interest that you earn will develop interest, and essentially it'll create a snowball effect that will allow you to yield more in the end once you're done with savings, arguably around the time that you retire. And there's an example of it on the right side here. So you'll see one investor starts when they're 25, sets aside $5,000 a year for 10 years in a row, and then stops saving after that point. Investor two starts when the first investor stops and invests $5,000 for 30 years until they retire at the age of 65. Even though they invested $5,000 for 30 years, as opposed to the first investor who only invested that amount for 10 years each, the first investor was still better off because the savings that she made earlier on compounded, and she ended up having more at retirement than the second investor did. That just goes to show you that it doesn't matter how long you invest for, it matters when you start, and the sooner, the better. The third key is to live below your means, and the only way to do this is to have a thorough understanding of what your means are. The best way is to track spending and to see what you are able to cut out from there and to totally change your perspective of spending as a whole. Yes, while you may be earning more, that does not mean that you have to spend more, because if you continue to spend in excess of what you earn, you won't be able to save any money. For instance, it could be something as little as a daily breakfast. If you go to Starbucks each day and spend $7 on either a coffee or a bagel, if you were to cut that out, within a year, you might be able to save upwards of $2,000. While this may seem small at face value, if you take into account the fact that you could do this over several years, and if you were to save the money that you would have spent on this breakfast instead and allowed it to compound, I mean, that could be upwards anywhere of something that could cover a down payment on a house or pay for a sizable portion of a college tuition. So it's something to keep in mind how these small decisions could have large impacts on our financial well-being. The fourth key is to realize that you are not indestructible. It's important to be aware of the benefits that you have through your company, whether they be healthcare or disability, and to also recognize that there are any shortcomings in those benefits. If the plan that you have through the company that you're employed by does not cover certain things, it's important that you purchase a personal plan that will be able to cover those and cover the difference. On top of that, it's also crucial to have an emergency fund that will protect you, your family, and your belongings in the case that any of those coverage plans do not work. Uh, it is also wise to review your insurance coverage after major life events, for instance, after the birth of a child or the loss of a family member. All in all, though, it's important to live a healthy lifestyle because this can oftentimes be the best deterrent against unexpected life events, especially those life events that might be related to your health. As we said previously, life insurance, for some, it may be more important than others. If you're single and don't have any dependents or in a relationship with someone who also is earning income, life insurance might not be the most necessary thing. However, if you do have dependents or a spouse that is unemployed or young children, or you're retired, have your own business, it might be wise to have a life insurance plan in place so that you can protect not just yourself, but your loved ones and all your belongings. The fifth key, which is kind of similar to the fourth key, is to protect your stuff and to look out for lawyers. Going back onto the issue of insurance, it's important that you have plans for your home, your auto, and for your life. The best thing to do to ensure the maximum amount of coverage is to keep your deductibles high and then look for discounts on those plans later on. It is also, especially in the case of auto insurance, important to look at the level of liability coverage that you have under your policy because you may possibly be uninsured. Liability coverage is just is an insurance plan that you have that will protect you against any claims that someone may have due to an automobile accident, due to any injuries they might have sustained in an automobile accident. Most liability coverage plans will not cover anything in excess of $50,000, while the average jury award can exceed close to $500,000. With that being said, it's important not to be cheap in this regard and to not seek minimum coverage, but instead to raise your deductibles and ensure that you have the maximum coverage necessary. Also, it's important to consider a personal umbrella policy that might be able to add an extra layer of liability coverage in the case of a freak accident that might affect you or your family. The sixth key is to embrace the B word, budget. So instead of looking at a budget as a limiting factor, something that's preventing you from spending more, it's important to think of it as a cash flow plan and something that will enable you to reach your long-term financial goals. The easiest way to track your budget is to use online budgeting tools such as Mint.com and Level Money. Mint.com is great because it categorizes automatically your spendings to determine where your money is going. For instance, if you're spending an abnormal amount of money on gas in 1 month, it'll be able to show you that. Or if you're spending too much on food, you could also see that as well. Level Money is also interesting because it tracks your spendable cash throughout. So it consistently updates and sees how much you have left to spend or whether or not you need to cut back on your spending for the month in order to be on track with your budget. It is important that, as I said, to use these apps to track your monthly expenses. And also, it's important to automatically deposit these savings into a mutual fund or other investment vehicle so that you're not just holding that money away, but actively growing that. And the seventh key to success is to reinvent and upgrade your skills. This is something that is often overlooked by some people. They think that if they are financially savvy and are doing everything they can to save and be on their best financial behavior, that it'll be enough. Oftentimes, it is not. Unfortunately, in an ever-changing world that we're in, people and skills can often become obsolete if they are not upgraded. It's important that you always take a step back and consider what are my skills and what value do they add to the firm that I'm employed by. It is important that if you are in a position where your skills may not be as valuable to your employer, that you acquire skills that are not only easy to master, but skills that your company will be willing to pay for. It can not only be a difference between you keeping your job or not, but it also could be the difference between whether or not you receive certain promotions or pay raises. All in all, education is the best possible investment that you could be making. So it's best to continue learning and upgrading your skills to put you in the best position to continue earning and keep your job.
Hi, everyone. I'm Louis Shaw, and I'm here to continue with the keys to financial success. The 8th key is to hide your credit card. Credit cards can definitely threaten your financial well-being, especially in the younger demographic and college students in particular. People spend approximately 30% more with credit cards than they would with a cash equivalent. And in part, that's because it's harder for some individuals to quantify how much they're spending exactly when they're using a piece of plastic than when they're physically handing over cash as they would in a cash transaction. Your goal should be to minimize your credit card debt. This means paying off your total balance every month, not just your minimum balance. Although paying off your minimum is an option, it really leads you down a slippery slope when it comes to reducing your credit score or incurring late fees, both of which are negative to your financial well-being. Key number 9 is that stocks are risky, but not as risky as investing in them. When it comes to investing, definitely manage your risk, diversify your portfolio amongst equities, long-term bonds, treasury bills, and other investment vehicles. An example would be a stock index mutual fund. This is because when you adjust for inflation, it's really unlikely that you're going to earn a significant return without having borne a pretty significant risk. Figure 17.1 from the textbook, highlighting the average annual returns before and after inflation from 1954 to the beginning of 2014, really highlights this because you can see the riskier asset classes tend to yield the more significant returns and vice versa. So when you come to construct your portfolio, obviously you want to achieve high returns, but you also want to understand and balance your portfolio according to risk, because risk and returns seem to have a very positively correlated relationship. The 10th key to financial success is to exploit tax-favored retirement plans. Tax-deductible contributions to an employer's savings plan, especially when your employer matches your contributions, are an excellent investment. Some people would even call this free money when your employer matches your contributions. It's a good investment because your contributions are not taxed and your investment earnings are not taxed until you withdraw them. So essentially, you're able to make money using money that otherwise would have been taxed, which is really beneficial over time. The 11th key is to plan for the number of children you want. Historically, if you think back to the 1800s or before, children could be considered assets because their labor would result in a gain to your financial well-being. But as modern society has shifted, nowadays children, until they reach maturity, are pretty much a liability on whoever is taking care of their financial status. So this historical shift means you really got to consider what the costs associated with each child are before having the child, and whether or not you're ready and prepared and able to bear those costs. The 12th key is to stay married. Divorces are really expensive. They can range from $1,000 to, as we see in the media with the Jeff Bezos divorce and other examples, there's really no limit to how much a divorce can cost individuals involved. Also, married people tend to earn more money and accumulate more wealth than single people and their counterparts. For example, married men earn 26% more than unmarried men. Married couples earn 61% more. And divorced women, on the flip side, with children, earn 40% less than their counterparts. So this really highlights the economic and financial consequences of marriage and divorce. Also, marriage promotes fiscal responsibility and exploits cost efficiencies for individuals. When you're married, you're accountable to another person for the purchases that you make. And then also you're purchasing services and goods for not just one person now, but 2 or perhaps more people, which in terms of cost efficiency is usually beneficial. So there's a lot of benefits to getting married and staying married. According to the Federal Reserve Bank of St. Louis, they analyzed the median wealth of married individuals in comparison to unmarried individuals and single individuals. And pretty much consistently from 1989 until 2016, married individuals' median wealth was significantly higher than unmarried individuals. So this is a pretty important trend to be aware of. So to tie things together, you should certainly spend less than you earn and make sure to budget. It's a very simple concept, but your financial success depends on living below your means. Have an active budget and stick to it. Don't rely on borrowing, financing, or lending to get you through your day-to-day. And then also remember, you're going to have to save for unexpected and expected financial events in your lifetime, such as retirement and education, or some kind of emergency that you don't expect. So you want to have at least some savings that you're budgeting for those specific situations. Also, know the costs of your transactions and your financial activities. This means tracking your credit card interest rate, your statement due date, your credit limit, to really be aware of what the cost of your borrowing really is. A good way to conceptualize what borrowing really is a quote from the textbook that says, foregoing future consumption opportunities in lieu of present consumption. So essentially, just because you're borrowing doesn't mean you're not going to have to pay someone or an institution back for the money that was lent to you. So really see borrowed money as money that is yours, that you need to pay back, and hopefully earlier rather than later, to really avoid getting yourself into a sticky situation financially. Also, identify good versus bad debt. Not all debt is bad. For example, when you borrow to fulfill a big life goal, or borrow something that's going to outlive its financing, or borrow for something that's going to provide a positive net return, it's usually worth it. So examples would be a home mortgage or education, for example, because both of those purchases are going to outlive the financing in terms of their value, and overall can be really, really beneficial for your financial and just overall well-being. Also, we have to examine the flip side. Borrowing does not make sense when you're just trying to support your day-to-day expenditures. If you're borrowing to support your day-to-day, you should probably borrow less. Also, payday loans, individuals and institutions referred to as loan sharks, are always going to be out there offering loans at really high rates. So you really want to avoid those because you essentially don't want to get taken advantage of. And then significantly depreciating assets like a TV. If you go to Best Buy today and purchase a TV, that TV probably won't be worth nearly as much 1 year from now. And so it might not make sense to finance that purchase. Also, repay what you borrow. Determine your ability and capacity to borrow and respect it. Just because you have access to capital, to financing, to lending, to borrowing, doesn't mean it's worth it. And again, there's plenty of individuals and institutions that are always going to be out there ready to offer you a loan, but also take advantage of you. So understand when you should take a loan yourself. Also, keep a strong credit score. It can really affect your access to loans, real estate, and employment sometimes. And then it also determines your individual cost of borrowing. If you have a low credit score, you're going to have high rates, and vice versa. And you can see how you can get trapped in a cycle, especially at a younger age, of having a low credit score and then not being able to dig yourself out of that hole because of this inverse relationship between credit score and rates. Also, treat your borrowing capacity as an emergency fund. This means you're going to have less liquid emergency funds necessary, and allows you to really put that capital to use elsewhere and potentially make a better return on it than just having it sitting liquid. And then finally, avoid living with debt. According to the Federal Reserve, credit card debt in 2019 cost an average of 14.87%. So you really want to avoid entering a situation where you're having to embrace and bear that 14.87% cost just to purchase an item. Also, borrowing to pay debt is completely unsustainable over the long term. So really look at certain activities and changes you can make to reduce your debt, such as eliminating certain lifestyle expenditures. Again, live below your means, pay more than the minimum, ideally pay the total balance every month. And then in emergency cases, be sure to liquidate investments before looking to other solutions. So when it comes to meeting your needs and maintaining your financial well-being. Thanks.
So now we will close out this chapter with a few behavioral insights. First up is the Prince Charming bias. This behavioral bias is based on the idea that something, regardless of how unlikely, is going to come along and save you from all your money problems and deliver you a life of wealth. Now let's take a look at changing behaviors. So where do we begin? One way to start developing good financial habits is to use an if-then strategy. For example, if you're building up too much credit card debt, you can tell yourself, if I'm buying something that's under $50, then I will pay cash. This is a really great way to start making yourself develop some better habits financially. Lastly, let's take a look at mental contrasting. Mental contrasting involves thinking about the positive aspects of change you want to make and then thinking about the barriers you face in achieving that goal. If you think about it, it's kind of like looking at the pros and cons of a situation. But what studies have shown is that this provides motivation for change and commitment. Now it's time to put everything that we learned into action and start building a better financial future. Start with budgeting and planning. Give an outline to your process and define your goals, develop a plan, and revise that plan as your life changes. It's also time to start investing. You want to think about retirement, you want to think about yourself 50 years into the future and the life that you want to live. If you start saving now, you'll be much better off in the future. It also starts right here, and the first step is to live below your means. Make informed decisions. Differentiate between needs and wants and decide what's more important to you. You also don't have to have everything everyone else has. Sometimes keeping up with appearances can leave us with tremendous debt, low self-esteem, and generally poor financial health. Make it a habit to have good financial health and make good financial decisions for yourself. And the best protection is knowledge. So the more you know about your financial decisions and the more informed you are on the way that you live your life, the better that it'll turn out for you in the end. Thank you so much for listening to our presentation, and we hope you enjoyed it. Now we will open it up for any questions. Thank you again.